Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. Markets have broadly been in ranges as participants try to assess the progression of interest rates. We have had data on the services side of the US coming in weak, German retail sales data also coming in weak, while equities are somewhat holding up. Good morning, JK. What would be the new triggers that can provide markets with a directional move? What's your thought?
Good morning, Swaraj. After 6 full days of trading in the new year, markets are still actually searching for a sustainable direction. We have had moves which just followed the themes of last year, basically dollar being weak. Uh, we have seen some more weakness in the last few days after a correction. Similarly, in the yields also, we had a correction upside, and then there have been some sharp dips as well. And we had the stock market, which started on a steady note, but then they have recovered as well. What the markets are looking for is whether the expectation on rate cuts are going to be realized. 6 rate cuts from Fed and equally from the BOE, and perhaps 4 from ECB. These are some things the market are looking at. And more importantly, they are looking at the fact whether these rate cuts will be for a good reason or for a bad reason. So bad reason, by bad reason, I mean if there is a financial crisis or recession, that can lead to rate cuts as well. Otherwise, if you have economy moderating, cooling off, and then inflation steadily coming down, then we also have a good reason for rate cuts that will boost the growth. So the former is not good for growth, and the latter is good for growth. So that's what the market is trying to assess. There is also an ongoing assessment on geopolitics, because we still have those troubles in the Red Sea continuing. So these are things that, and of course, the Japanese monetary policy. We had another CPI number today from Tokyo region, which is normally a leading indicator for how the economy is facing the inflation going forward. And that came quite well within the expectations of the market. So there is no fresh trigger for Japanese to, indicate a change in the policy. That said, Japanese yen is really not weakening like it used to earlier, and perhaps catching up a bit with the lower yields on the US side. So that's how the market is kind of mixed right now. Some either an event or a policy direction is all what the market is looking for. Of course, we have later in the month, we have the annual Davos meet also, where there could be some indications on what's likely. More specifically on days trading yesterday, we had the rupee continue to exhibit some strength, good selling seen right from the open, breaking 83.10, trading down to 83.05. But then we had the usual import buying on the dip, which came right on the queue, and then we had moved to 83.15 from there on. Of course, in the offshore market, rupee once again tended to strengthen on the news that Bloomberg bond DM index will include the Indian bonds, Indian gilts rather, in the course of next 5 months, perhaps from September. Not a immediate impact on the flows, because it's some timeline away, but a positive news as well. And then there was also news about some oil discovery in the Telangana region. That's also something which the market was looking at. So these are something which eventually will play out to rupee's advantage, but not immediately. So rupee broadly stays in the range, but perhaps a widened range is what we are seeing. Global markets saw once again up and down movement in the yields. Yields, of course, dipped sharp, rather rallied sharply after the European assessment of the consumer sentiment that came at a 22-month high. And we also saw the Eurozone retail sales beating expectations, and this was quite contrary to what we saw in Germany. These are some things which are actually keeping the euro well bid. Yesterday there was an attempt to go down, but again got very well supported. So euro is back above 1.0950 and continuing its slow grind higher. against the dollar as well. In the US time, of course, the yields again came down when the inflation expectations dropped, across the tenors in the US, and that saw the yields come down. And one more factor that contributed to yields coming down in the US session was a late reaction to the Saudi price cuts on official price cut on the crude prices that is taken it to a more than 2-year low. And that, means you will have a headline inflation falling once again. Already there is an expectation that month-on-month consumer price index for the month of December will fall by 0.1% in the upcoming data on Thursday. So these are things that, once again push the yields down. But then again, there was also a data on employment trends, which is published by the conference board, and that indicated that in December that's actually quite strong. Employers are looking to hire more, and so this is actually a leading indicator, whereas the non-farm payroll is a lagging indicator. So that's again one more reason for the yields to become volatile, and this time on the upside. So we closed in the middle of the range for the day, still searching for the direction as far as the next big move is concerned. For the stocks, it was the first big rally in Nasdaq in the new year, and it was a blistering rally, of course. Not surprisingly, markets scooped up mega cap stocks, which had dipped very badly in the first few days. And then this is buying that has happened up to 4% drop in the index. S&P 500 also rose smartly. Dow was somewhat held back because of the selling in the Boeing shares after the grounding of some of the MAX planes. So that again is a slight mixed picture in the US markets, but all said and done, all the three major indices were down, but by different margins. On the currencies, we had again, as I said, there is an underlying tendency to sell the dollar, which is clearly evident in the euro and GBP being bought on every dip. Even the USD yen has shown tendency to come off despite the yield, rather the inflation number not showing any tendency to rise. I think overall the underlying trend, which we have been mentioning for some time for the dollar, is down. Not really broken into a new high, but definitely there is a underlying sentiment to keep shorting the dollar. Of course, not so much reflected in the gold, because gold is facing some sort of a selling pressure due to profit taking perhaps, and also because in the new year people are tending to buy other risk assets and not really looking to add to their gold, in which perhaps the market is already long. So but eventually gold, as and when we get more indications about the rate cuts across, we will see gold catch up and also break into new highs. So entering another day with the same rangy mode, but perhaps sooner or later we have some direction emerge, hoping that the CPI will provide that. Thank you.
Thank you, JK. And the basic theme which I got was, of course, market searching for a direction and trying to guess when rate cuts happen and whether it will be because of a crisis or just a slowdown backed cut to boost the economy. Now, we had the Japanese inflation, which came within expectations, but yen has been trading with a strengthening bias. Rupee strengthened in the opening session yesterday as well, but it remains range bound with a wider range. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.